right? What is this thing called? What is this thing called? This kind of display. This is called a heat map. Somebody said it, but not loudly enough. Okay, so you can see it's a sea of green. This is partly because of all kinds of optimism, because the economy generally is quite strong. Last month's jobs report was very strong, and then of course the main driver now is the two trade deals, and especially the phase one of the China trade deal. So all this news is coming. So this is what I've told you guys to do: continuously monitor markets and also monitor the news flow, and try to relate the market movement to the news flow and see to what extent it makes sense, because this may also affect your decision to become a technical trader or a fundamental trader. If you come to the conclusion that the market moves are not, it's not possible to explain the market moves based on fundamental analysis. So this is fundamental reasoning that will always be given by the market. But if you look closely, you'll find that sometimes it doesn't really make a lot of sense. Like companies announce earnings, then very good earnings, but the guidance is poor, so the market drops. And the next quarter, the same thing doesn't happen. So it's kind of difficult to figure out what the market wants to focus on. Okay, so anyway, you can see here how this sea of green, and the way the heat map works is, so the stuff which is up more will have a bigger deeper green and all that. I think the lighter green, because Facebook is up 196, it's lighter than Amazon. So this is how it is, and you can always, as you can see, you can change the performance and check it. So you can do this for any market. This is right now for US markets, but the concept is what is important. Okay. All right, so let's get back to our discussion. We were discussing, so what have we discussed with respect to our balance sheet? With respect to our balance sheet and this particular case, what we have discussed is, so this balance sheet that we have, okay, what we have discussed so far is we have discussed risk books, two types of risk books. Let's just look at the oil chart. Oil prices are moving up, you would have noticed. Okay, so we have discussed risk books, two types of risk books. Then we have discussed the concept of KRFs. Okay, every KRF is a price in a KRF market, and then you have the concept of the underlying position, which is also related to a KRF market. For each KRF market, you have some underlying position or the other, long or short. Then we have discussed hedge positions. We have discussed the logic of hedge positions. What is the objective of the hedge position? Is to offset the underlying position, and that you put on. Yes, why are people looking blank? Are you following, Ritesh? You're following? Okay. So the objective of the hedge position is to offset the underlying position. Okay, and so this you put on the hedge position only when because you're constantly monitoring the KRF markets. Like one of your KRF markets is crude oil, and your underlying position here is long, and you're constantly monitoring it. So if you monitor this, and if you have a bullish view right now, let's say, in that case you would not. Your decision is not to hedge. You don't buy. We'll come to that golden rule of hedging, but we have already discussed this point. Remember that this is what makes it different when you are running. This is one of the differences between running a hedge portfolio versus running a speculative book. Remember, in a speculative book, if you were trading, what you did in your first two projects, in the NSE project and the option trading project, if you were bullish, you would buy. If you were bearish, you would sell. Right? In this case, it's not so simple, because you have to be conscious. You already have a position. You already have an underlying position. So your hedge position has to take account of that. So you have to monitor the KRF market in which you have an underlying position. So if you come to a conclusion after monitoring, if anyone doesn't understand what I'm saying at any step, please stop me. Okay, I'm going quickly because these things have already been covered. Yes. All right. So if you don't understand any comma or full stop of what I'm saying, please make sure you stop me. So because you already have, the reason it's not so simple, not as simple as running a speculative book, is you can't just go long when you're bullish and short when you're bearish, because you have to be mindful of your pre-existing underlying position, which is why it's called a passive risk book. Because of the nature of the business, you already have some positions. All right. So you're monitoring that. You know that in this KRF market, your underlying position is long. So in this case, if your view is bullish, all this stuff is already there in your notes, okay, in all your project briefs. So there's really no need to write anything. Just make sure you understand it, and you can always ask me later if there's anything which is not clarified. So if you have a bullish view here, what will you do? Buy. You just said buy. What is your underlying position in this KRF market? Long. So if you have a bullish view here, what will you do? If your assessment becomes, remember this is a key to all decision making, which is why you're made to do all these projects. The key to all decision making in finance roles, at the heart of it lies taking a view on the market. Whether you're raising capital, issuing, putting through a debt issue or an equity issue, everything centers around taking a view on the market. Okay, so you have to take a view on the market when hedging as well. So if you have a view on this and your underlying position in this KRF market is long, okay, what will you do? Yes, Kanika, what does your WhatsApp say? What will you do? You're not paying attention. Don't look at your WhatsApp. Put your WhatsApp on the table, maybe at least as a first step, instead of giving it to, yeah, put it there and don't look at it. Now, any idea what is Aurora going to tell us? If my KRF, if my underlying position in this KRF market is already long, you know that we have seen this. When you go to the balance sheet, you see that the inventories, one of those items is oil. You got 25,000 barrels of oil in inventory, so your underlying position is long. Yes, you agree with that? You helped us with a question on that point earlier. Now, if you have a bullish view, when you look at this, you have to analyze the KRF markets. You have to constantly monitor each of the markets. So if you have a bullish view on this, you will buy. So you're joining everybody here. Yes. Who else? SG1. What is the? Is my question clear?
Yes.
So what will you do if you analyze the market and you come out with a conclusion that your underlying position is long? If the market view is bullish, the market is going to be going higher. What will be your action? You'll go long. Okay. Anybody else?
We will not do anything.
Yes. So Tarun is right. You will not do anything because you already have a position. So you have to, when you are looking at what kind of decision you're going to take, you have to think about there are two possibilities. Okay. Either you buy or sell. Three possibilities. Either you buy, sell, or do nothing. All right. So the point is that what you have to think about in terms of your logic for hedging. Okay, this is where hedging differs from speculating, from running a spec book. That you have to see if your view is correct. So, and everything is based, all your actions are based, and this is true in all finance roles. Okay, all your actions are based on the assumption that your view is correct. Okay, so you have to assume that your view is correct, and then you take the action. Of course, it may turn out that your view was wrong, but that's what you have to live with, right? So, if you already have if your view is bullish, okay, if the market moves up, then what will happen? The underlying position, will it be showing losses? If the market price has already moved up from that price we had put in earlier, it's over $60 now. When the market price moves, is your underlying position showing losses or profits? Profits. Okay. So the rule of hedging is that if you expect your underlying position to move into profit, then you don't hedge. Okay, we'll come to that because we'll come to the golden rule of hedging. But let me just quickly wrap it up here and tell you this. So this is what makes, then we'll get into it systematically. So the point is here, because you have to be mindful of your underlying position. You already have an underlying position. So in this case, if your underlying position is long and if the view is bullish, that means the market is likely to move up. In that case, your underlying position is likely to show profits. Okay, so in this case, you don't hedge. You do nothing. So out of the three actions, buy, sell, or do nothing, you do nothing. Why are you doing nothing? Because based on your view, you expect the underlying position to show a profit, okay, or to the valuations to improve on the underlying position. Yes, is everyone clear? So that's what drives your actions. You don't do anything. But if your view is bearish, if you feel that this is pretty much the top, the market is now likely to drop to 52.50 very sharply. Now what will happen? Now go back to think about the logic. If the market drops from $60 to 52.50, what will happen to the dollar value of your inventories? They will rise or fall? Yes, Ganotra? If the market drops, if the crude oil price drops, we're just focusing on the crude oil inventories, but the logic is the same for everything. If the market drops, if the crude oil price drops, what will happen to the dollar value of your, let's say it drops from 58 to 52? What will happen to the dollar value of your crude oil inventories? Will they rise? Will it rise or will it fall? It will fall, right? So the dollar value of your crude oil inventories will fall, and then what will be the impact? And you have to carry it through to the impact on the net worth. What will happen to your net worth? Decrease, right? Because if the dollar value here reduces, there's no residual quantity on this side, on the asset side. So anytime there's a change on the asset side, the balance sheet size is affected. You follow that? You have to you need to be following these logical steps, because on the asset side there is no stabilizer like the net worth figure. There's no kind of a residual figure, no residual quantity. So if the asset side anything changes, it changes the balance sheet size up or down. So if it changes the balance sheet size, then the balance sheet size is basically either total assets or total liabilities. That's what we call the balance sheet size. So if that changes, then the liabilities will also change, and then the outside liabilities will not change in value because lenders will not accept a cut in their loan. All this logic is explained in your notes, okay, in your project brief. So, but you need to be clear about this. Instead of mugging up, you need to think through it in your head and be clear about it yourself, because I can see that many of the things which have been discussed people are not clear about, okay, because people are busy looking at their WhatsApp when the class is being conducted. Okay, so please make sure you're clear about all these concepts. Everything that is being taught, like in most of the courses, they're all conceptual. You have to be clear about your concepts. Once you understand the concept, you'll never forget it in your life because it's logical. So you'll actually gain some value from the course. All right, so this will reduce in value. This will affect the balance sheet size. It will go down. And then because the liabilities will also go down, because the outside liabilities will not change in value, and therefore to accommodate the drop in the total balance sheet, total liabilities figure, because outside liabilities will not go down, so net worth has to go down. This is clear? Yes? Okay, so this is the logic that you have to give. All right, so this is what is going to happen. So therefore that's what drives your hedging decisions, not just the fact that which is also true, that the underlying position will start showing losses, right? But the total impact of that, you have to carry it through to the net worth. Everything goes down to net worth. If your net worth is likely to increase, then you don't do anything. But if your net worth is likely to decrease, then you act. Is this clear? And based on the strength of your view, you may hedge the entire 25k, or you may hedge 15k or 20k or 5k or whatever it is. That's a decision that you can make. Okay, you have the flexibility. That's where the hedging team has flexibility, and that's why the performance of every team will differ. That's one of the reasons, because even your decision to buy or decision to hedge or not to hedge, that will also affect your total profits. Okay, so we'll see how this is going to work. So everyone should have been clear about all this by now. Okay, so if you take a view on this, and so we've covered all this hedge position. What else have we covered? We have covered. We of course covered the idea of. Please make sure you remember that because the euro-dollar futures are not part of your trading project. The dollar LIBOR risk on the balance sheet, we are not going to include it as part of our trading project. We don't have enough capital in the account, so we have discussed it separately as a theoretical discussion. How you use euro-dollar futures to hedge interest rate risk. Remember, we discussed about taking views, and all those cases are all those scenarios are in your spreadsheet. So what have we discussed here? Okay, we have discussed interest rate risk with euro-dollar futures. Then we have discussed why dynamic hedging programs are more risky. We have discussed that as well. So we've discussed the difference between the static. We after underlying position, we discussed the hedge position, and we discussed the logic of the hedge position, which we have just now gone through again, right? That if you think that there is going to be, if you think based on your market view that the underlying position is likely to lose value, which will eventually filter through to a drop in net worth, okay, on the asset side if there's the underlying position. And then accordingly, based on that logic, you will decide to hedge when you feel that your net worth is likely to go down. If your net worth is likely to go up, okay, then you don't hedge. That's the basic framework of the hedge position, the logic of the hedge position, and that the hedge position is an offset. And then we also discussed static versus dynamic hedging programs. Remember that? Yes? Okay. So static versus dynamic hedging programs. Static programs are where you can, once you put on the hedge, you're not allowed to lift that anymore. You're not allowed to unhedge anymore. Okay, so first you have the underlying position. If you take a hedge position, that's basically called you hedge. If you lift that hedge position once again, that's unhedging. Okay, so hedging and unhedging, this is only allowed in a dynamic risk management program, which is more risky because you open up the underlying position once again. You are increasing your risk, which is against the philosophy of hedging, right? and then you also are crystallizing losses. You could end up crystallizing losses, so you need to have risk capital for that. So we've discussed that point as well. Now we go on to the next point. Okay, let's go on to this is 1712. Okay, so we are going to discuss now. Let's see. I've actually put this in your spreadsheet as well, so that you have a in what are the topics we have discussed in the case. Okay, so what are the topics we have discussed in the case as far as the case is concerned? Okay, this we have. Okay, now what is the scheme of the project? Let's understand the scheme of the project and what your goal is. All right, notice that there are two. There's a third. Yeah, in this case you don't have that. So you notice this is the starting. This sheet says starting balance sheet. Now we're going to explain to you how the whole scheme of the project works, which is how any risk management program for a hedger, for a passive risk book, is going to work. Okay, any risk management program for any book, actually, even for an active risk book, when you're doing hedging, there is. It's going to work in the exact same way. So you have a set of underlying positions which is shown on the starting balance sheet. Okay, so the way things are going to work is that at the start of the project, I will whatever that date is. I think that's whatever it is. Okay, so the date of the starting date of the project will be over here, and I will enter the values. So starting date is a Monday, so I will take the Friday closing, previous Friday closings in New York. Okay, and I will enter those values over here. These are the prices. Okay, I'll enter those prices over here. That will give you a set of starting values. Yes, everyone's following? Okay, so that will give you a set of starting values. I will also enter the market prices for these on Friday New York closings. Okay, for all these variables. Okay, we will take a note of LIBOR as well, but it's not part of the project, but logically you should do that. And then we'll put in the Aussie and the dollar yen values as well. So now what will happen is that combination of prices is going to create a net worth figure. This will lead to a different net worth figure because the prices would have changed by next Friday, right? The Friday after next. This is going to happen the Friday after next. New York closing. After the New York closing, I'll take in the prices. So prices would have changed. So the net worth is likely to have changed. So whatever that starting net worth is, that is just going to go over here. Okay, the same figure. This is just the same as that row. Is this clear? You have the starting net worth. Okay. Now what's going to happen at the end of the balance sheet, at the end of the project, I will do the same exercise. I've not changed the figures here and the dates. I'll change the dates, but this is now the balance sheet end. So this is going to be the same exercise. Now what will happen? These prices I will put in after the project ends. Okay, so whatever that date is, when January 15th or whatever it is. So after the project ends, which will again end on a Friday, the project will end on a Friday. So we are talking about there's going to be a gap of 4 weeks between this set of prices here, okay, which is going to be at the start of the project, and then there's going to be a gap of 4 weeks, and then there'll be a different set of prices here. Is everyone following? Yes, are you following? So I'll put in the Friday closing prices for the end date of the project. So that will lead to a different net worth figure, right? We can see that there's going to be a different net worth figure, and then we can actually we can do that. Let's say these prices become, let's say, 1350. This becomes 2.2. This becomes 55. I'm just putting in some arbitrary prices. This becomes 109. Let's put in 110. This becomes 65. All right, so you can see that net worth has gone down. So let's assume that these are actually the starting prices to save ourselves the labor. Let's assume that you started with a net worth of 2.2. Yeah, you started with 2.2 net worth over here, but at the end, when we put in the prices, you will find that your net worth has gone to 1.5. All right, so here it shows your USD PNL should be showing here. Why is it not C13 by this? Anyway, I will
because even the first one is changed.
No, where is C13? Yeah, so this has to be, just formula needs to be changed. This cannot be the closing reference. I've not entered this closing. Yeah, this thing should be actually coming from here. This should be actually taken as I'll change the formula, but you get the idea. This is actually this is not the closing reference, this is actually the opening reference. I don't know why I've written this as closing reference, but is equal to G13. Where is G13? Okay, no, this should not be there. Let's change this, okay? Let's change this to, I need to make this a space threshold. Alright, now you see this, okay? So, this is not the closing reference. But anyway, this formula is not correct. So I need to change I must have had a different formula scheme. But basically what's going to happen is this. Let me write this as like this, okay? That is the right way to write it. Now 1 minute. H2 minus G13. This should show a loss actually. H2 minus G13. I don't know why it's not showing a loss. Oh yeah. See, right, correct. Very good. So this actually, if you remember your formula when we were defining the trade risk calculations, right? When we were doing the trade risk calculations, you have to write it as exit price minus entry price. So the closing is actually very good. So this is actually this minus this. Now it shows this loss. Okay, is this clear? Now, if you see here, is everyone clear about what we have done so far? Okay, you start with the ending. We start with the starting prices. Okay, and this is exactly how a hedging program would work. All right. So you start with the initial prices, and then at the end of the hedging period, you again compute the total value of all the underlying positions and the closing net worth, right? And then you take the closing net worth minus starting net worth. That was basically going to give you your P&L. Yes. In this case, you see that the underlying position has lost value because the net worth has gone down. Yes. Okay. All right. So in this case, what we'll do, so this is clear, this is something you can't do anything about, right? Because as we said, the underlying positions, they change as a function of what the business is doing, right? What the business is doing in its day-to-day work, right? Garvit, don't look at your WhatsApp. Put your phone on the table. Put it on the table so that Ganotra also put your phone on the table. Don't keep looking down. Put your phone on the table. Yeah. Okay. So is everyone following so far? As the underlying positions on their own, they don't change. You can't do anything about it as a hedging team. You have to because those positions change only as the business goes through its operations. Okay, so when you do a sale, when the sales team negotiates a sale, then the positions go down. Okay, then the underlying position, they no longer show it as unhedged inventory. So if they sell, say, 10,000 barrels, if they sell to if they are able to sell 10,000 barrels to Japan, okay, then the underlying positions in crude oil will go down from 25k to 15k because they've already locked in the sale. Once they conclude the sale contract, they will move it off the inventory. The inventory may show for accounting purposes, okay, but the price risk for purposes of hedging, you will prepare a separate balance sheet which is unhedged inventory. This inventory is basically going to show the unhedged inventory. Is everyone following? If you have inventories of crude oil and you have got 25k of inventory, this is unhedged inventory. The moment you sell 15k barrels to Japan, the price risk on that contract, the market price risk has been locked in. So unless Japan defaults, there is no problem. You will get that price realization on that 15k barrels. Are you following that? So therefore your unhedged inventory will go down from 25k to 10k. Yes. So this is happening as part of the normal operation of the business. So this is not something that can be changed by the hedging team. They can't tell the sales team, okay, please quickly do your sales. They have to do the sales based on how the business operates, the normal cycle of the business, depending on how customers decide and all that, right? So you can't affect all that. The idea of hedging is that you should not disturb the underlying operation of the business. Is this clear? Okay. So what you can do is, what will happen is, now let's go back to the scheme, right? Let's say with your judicious, let's say that your view on this market was bearish. Okay, and therefore you were able to see that the prices would quickly drop to $50. Now at this point, therefore, you would have sold 25 contracts and hedged the entire position. because if the price was going to drop quickly from $60 to $50, there would be a huge loss on the underlying position, and that would reduce the size of the balance sheet. That would reduce total liabilities, because outside liabilities can't change, so net worth would have reduced. So based on all this logic, based on this fear, you would have hedged the entire unhedged inventory of 25k barrels, yes, with 25 contracts. So you'd have sold 25 contracts. You would have gone to this, and you will go here and you will sell 25 contracts by hitting this bid. Okay. So if you do that and then you'll show this profit, what will happen essentially is, we have already gone through, I think we've gone through this in a post-class discussion, but which is nevertheless part of the videos which we had with Tarun, that this, when it drops from here to here, what will happen is, if you are smart enough to see this drop and you're able to hedge the entire 25k at 60.20, effectively the net result is that you have realized the 60.20 price for your full 25k inventory and you have locked it in. The net realization is locked in. That's what happens essentially. The price at which you hedge, whatever amount you hedge, you have locked in, especially if you're taking the, we are going to have the discussions with respect to a simple static hedging program, because it's easier to understand the concepts. But even if you do a dynamic hedging program, they will obviously, you will open up the thing. We can come to that discussion later, but understand it with respect to a simple static hedging program, where once you hedge, you forget about it. You don't unhedge anymore, right? So in this case, if you have hedged at 60.20, if you hedge your entire 25k, now what happens? Next day the price drops to $50. So your underlying position shows a loss of 25k barrels times 50 minus 60.20. Yes, everyone is clear? The underlying position shows that loss, right? But the hedge position, what will happen to the hedge position? Because the hedge position is short, the hedge position is short 25 contracts over here at 60.20. Yes. So the hedge position, what will happen? Will it show a profit or loss? Short position. Yes, what will happen? What will happen to the hedge position? If the price drops from 60.20 after you sold 25k contracts at 25 contracts at 60.20, and then the next day the price drops to $50. So what is the P&L of the hedge position? Is it a profit or a loss? 1 minute, let her answer. Yes, Garvit, put your phone over here. Give me the phone. What are you looking at then? Okay, yes. 1 minute. So nobody else should talk. 1 sec. What did I say? We took a view on the crude oil price. We are conscious of the fact that our underlying position is long, right? So therefore we went short because the underlying position is long. Our view on the crude oil market is bearish. Okay, our underlying position in this KRF market is long. Our view on the market is very bearish. So what is likely to happen to the underlying position if I don't do anything? It will lose money because the prices will drop. Eventually they will lead to a drop in net worth. So therefore I must protect against that. The objective of the hedge position is to protect against losses in the underlying positions, okay, or reduction in net worth from adverse price movement with respect to the underlying positions. Okay, so in that case I went short. I hedged the entire unhedged inventory of 25k barrels. I sold 25 contracts at 60.20. Next day the price drops to 50. So my question now is, my hedge position only, no, forget about the underlying position, is my hedge position showing a profit or loss? If I went short 25k contracts on my hedge portfolio, I went short 25 contracts, or not 25k, but 25 contracts. If I went short at 60.20 and the next day the price drops to 50, so is my hedge position showing a profit or a loss? Profit, right? And what is the amount of the profit? Multiplied with 50. Profit will be calculated the same way, remember, just as 1 minute. Yeah, around $10 into how much? 25? Not 25, but 25,000, because the price is per barrel. These prices, crude oil, are quoted as price per barrel. If you have any doubt, you can go to the website, CME website, look at the contract specs and see that the price is quoted per barrel. Okay, it's not per 10,000, not per 1,000 barrels. So there's a difference between the price quotation system and the unit of the contract size. Okay, the contract size is 1,000 barrels, but the price is quoted as per barrels. So you have to calculate your P&L. You have to use the same formula which is already there on your sheet, let's do the calculation once again, just so that everybody's clear. Your loss is calculated. You have to set up all these losses. Okay, so what is your position? Minus 25. Okay, yes, because your hedge position is short, so your hedge position is 25,000 because each contract is 1,000 barrels, so you're minus 25. So this is your position. Okay, exit price is $50, entry price is 60.2. all right, so the way you write the formula is same formula. So we have to make sure that the formula is the same, the general formula, so it's easier to remember. Okay, the principle is easier to remember, and we write the negative. This is all in your notes from previous sessions, okay, from previous courses where we wrote down all these formulae, right? So you write the formula as position size into exit price minus entry price, and if you are going short, you write the position size with a minus sign, right? So it's logical. If you're going short, the position size will have a minus sign. So you have a minus sign. You have this into. So that's why you don't have all these complicated, because even in the last exam people have messed up. This is your exit price minus the entry price. Okay. Yes. Why is this coming out again? What did I do here? Oh, I did it the other way.
Yes.
Actually, I should have, the exit price is actually H12, not H13. So I just chose the wrong cells. Okay. So H12 minus H13. Okay. Okay. So this will show now, as Mehak has told us, this will show a profit. Okay. So this is a profit. But so this is the hedge position P&L. Okay, so the hedge P&L, we will just call it a hedge P&L. This is the position, the P&L that is showing in the hedge portfolio. The hedge portfolio will consist of all kinds of positions, can consist of all kinds of positions relating to all of these contracts. Okay, so if you go here, you could have positions in crude oil, in gold, in copper. You could have positions in the dollar yen and positions in the Aussie. All the hedge positions, all of these will be hedge positions. Okay, so you take all the hedge positions together, that's your hedge portfolio. All right. So the total P&L on the hedge portfolio essentially, so in this case we take an example of a simple single position, okay, where the underlying position. So we take an example of one KRF market only. We see that our hedge position shows a profit of this much, about $250,000. But the underlying position would have the same loss, because the underlying position is plus. So all you have to do is basically change. In this case, if you want to calculate the underlying position, you would just change, or we can do it here. So we can do the underlying position calculation that we are discussing here and the hedge position calculation here, and we can make it a little smaller so that everything can be seen in one view. Okay, is everyone able to see all this? Yes? Puneet, are you following? Okay, so this is your hedge position, P&L is this, and what is the underlying position? It's not minus 25. We know the underlying position is plus 25. Okay, the underlying position is already there on the balance sheet. It's plus 25k. Okay, so on 25k you lose when the price moves. So this is, we should call this the the entry price, ENP, and this is the exit price, and this is the position. Okay, so we can take this up as well, and obviously this is your P&L. Yes, everyone is clear about this? Is everyone clear about the calculation? What is the situation that we are looking at? You're here on the oil market, you have an underlying position on the crude oil market which is long, right? And you take this, look at the market, you do your market analysis using fundamentals and technicals and everything, and you come up with a view. okay, and your view is that the market is going to collapse, the price is going to collapse, so you quickly hedge all your inventory, all your unhedged inventory of 25k barrels. You hedge it by selling 25 contracts, and you go short 25 contracts, and the next day the price drops to 50. So your entry price for the hedge is 60.20, and the exit price for the hedge is 50. Okay, $50. We'll take it as so. We're calculating the P&L. We are assuming that the whole program is over in one day, just to understand the concept, right? And when it drops, I'll come to you, Khushbu. I'll just explain this once again. So is everyone following this calculation? Yes. Okay. So we have the underlying position, the hedge position. When you go short 25k, you have, this is the entry price. So on this formula you make $250,000 on the hedge position. But on the underlying position, because the underlying position is constantly being revalued, you have to imagine that the underlying position is being constantly revalued at market prices. Remember, I told you that you have to imagine that your balance sheet is constantly being revalued at market prices. In practice, of course, it will not happen probably earlier than a quarter. In practice, when you're doing accounting, reporting and all that, when you might have to revalue your inventories. You might have to do it on a quarterly basis or half-yearly basis. But for the purposes of a hedging program, you will have to imagine that your balance sheet is being revalued on a second-to-second basis with updated market prices. Is everyone clear? It's almost like you have DDE links in your spreadsheet where you're updating the latest unhedged inventory positions, and then there are DDE links here which are feeding in the market prices directly from a trading software like this, where you're getting all the market prices directly into the spreadsheet, and your total US dollar market values are always changing dynamically second to second. Is everyone following the scheme? You have to assume that your underlying position is being revalued on a second to second basis. The whole balance sheet is being revalued continuously. All right. So in this case, the latest revaluation before you went short, the latest revaluation of the balance sheet would have been at $60, $20, because that was the market price when you went short. And we'll create an artificial situation, and we'll assume that, we'll forget about next day, the very next price is actually $50. Next second the price drops to $50. We're just creating an artificial situation to understand the logic. So the logic will not change even in a normal situation. So after you hedge at 60.20, okay, the price drops to this. So on the hedge position you make a profit of $250,000. This is clear to everyone, right? And on the underlying position, what happens, because the entry price, basically here, entry price is going to be the last price at which it was revalued, because you're imagining that the balance sheet is being continuously revalued, okay, at market prices. So it's almost like the balance sheet, the market prices are feeding in through a DDE link. So latest market prices always, latest market values therefore always. Yes, everyone is following this. So therefore, for the purposes of calculating the P&L on the underlying position, you will take the latest market price or the previous market price where you went in with your hedge position, okay, because we are considering the impact on the P&L from the movement of the price from 60.20 to $50. So you can say this is period 1 and this is period 2. Okay, so since we are considering this scenario, we will take the equivalent of the entry price on the underlying position as the period 1 price, because that is the last revaluation. We are trying to calculate the loss between period 1 and period 2. Is everyone clear why we are taking please make sure you understand the scheme of calculating because everything has to be understood through each step, logical step. Otherwise you will not understand the process, okay? You will not internalize the logic. Right. So is everyone clear about this? Why this is taken as the entry price? Because you're calculating the loss between that occurs between period 1 and period 2. So for the underlying position P&L, you take the period 1 price as the entry price, and the period 2 price is taken as the exit price. Yes? Everyone is clear? Yeah? All clear? Okay. Yes, Kulfu, what is your question? So therefore, so therefore what happens is once you apply the same formula, the size of the underlying position is long, right? And so the P&L on the underlying position is 255, okay, minus, same as the P&L on the hedge position, but with a negative sign, with the opposite sign. Yes, right? So therefore what it shows you is the truth of what I told you just now, that when you go and hedge your entire position, okay, or whatever amount of the position that you hedge, you have effectively locked in a price of 60-20 for your inventories, because the underlying position loses $250,000, but the hedge position makes up $250,000. So when you total up the two P&Ls, hedge position plus underlying positions, your total P&L is zero. Incremental P&L is zero. So the price is locked in effectively at 60-20. Is this point clear to everyone? Have you understood the scheme? So similarly, what will happen here when you're doing here, this is why we are discussing the scheme of the project. So we noticed that the based on the movement in prices and the movement of the underlying position, movement of the valuation of the net worth changes in between the start of the project and the end of the project, right? Based on that, you have the underlying positions have lost this much amount of value, $730,000. Is everyone clear? Yes, are you following this logic? Yes? Okay. So if this is the case, we will also then separately look at what the hedge P&L has produced. What is the hedge position? Because you would have been doing some hedging throughout these 4 weeks of the program, and just like this 255,000, etc., you would have made some money. Maybe you lost some money. The hedge position could have lost money as well. It's because you're going to be doing a dynamic hedging program, right? So in that case, what will happen is we will put in, this is what you guys have to put in. You have to take your hedge P&L from the beginning. This is what I will verify. So I will need the starting and ending account statements to be put in as PDFs. Okay. Now here, Tarun, go. I told you to sit at the back. Why didn't you go? I don't want to see any more. No, go and sit at the back. No, go and sit at the back. Sit with in Puneet's row. Go and sit in Puneet's row. I already told you, don't sit here. Yeah. Okay. So sit on the outside. Then you will disturb Puneet. What?
Dirty.
Table is dirty. Okay. All right. Okay. All right. So what are we talking about? Yeah. So you will calculate your hedge P&L based on the starting account value versus the minus the ending account value. You'll calculate your hedge P&L. Let's assume that your hedge P&L ends up being 245,000. Okay. So now notice what happens to the net P&L. Everyone can see the net P&L here. So your net P&L reduces.
Yes.
Because when the net P&L is nothing but the hedge P&L, as you can see here. The net P&L is nothing but the hedge P&L plus the underlying position P&L. Is everyone clear about the scheme? Now you've understood the scheme. So this is how all hedging programs will operate. Even when you're running, you can, strictly speaking, run hedge programs even for a speculative book, okay, which is more common in active asset management, in traditional asset management programs, which are typically just long only on bonds and equities. So they may run some, so even speculators can run hedging programs, but we will not complicate our understanding at this point of time. But once you understand the concept of hedging clearly in terms of underlying positions and hedge positions, once you understand the logic clearly, you can apply that logic even in a speculative trading book. Okay. So we'll discuss that later, hopefully at the end of the project, at the end of the discussions for this case. So everyone is clear about this now? So then we will tally the teams and I'll rank the teams based on the same system, okay, pro rata or etc. And we'll score. So this is your score essentially, right? So what you'll have to report is basically the starting and the ending. I'll send you the instructions. You'll send, I'll put in the instructions in your project brief. So you'll have to upload the PDF statements for the ending of the period and the closing of the period, so that I can verify your account balances. The change in the account balances will be your P&L. Is this clear? And your responsibility is to take that figure and put it directly into this. Yes, everyone is clear? This will be here, and then you put in your group members and TWS ID and password, and then you send it to me. Okay, so this is going to happen. So now you've understood the scheme. What is the goal of hedging? You can understand it with, even if you understand it with respect to one KRF market, then you can understand the whole scheme, because the whole scheme is nothing but the addition of several KRF markets. So once you've understood the logic for one market, it's the same logic for every market. Yes, you just have to keep repeating it. Obviously there's a lot of work involved because you have to monitor each market, but the logic that you're applying in each market remains exactly the same. You're going to be asking the question, if I don't do anything, is my net worth going to rise or fall? This is basically the question that you're asking. Okay, and that of course the answer to that comes from looking at what happens to the asset values or the liability values. Okay, when you're looking at this side of the balance sheet, it's not always that you're looking at asset values. When you're looking at this side of the balance sheet, you're looking at liability values, right? So therefore this also has a different, but the question that you're always asking is what is going to happen to my net worth if I don't hedge? Okay, and then if you think net worth is going to go up, then you don't hedge, and if you think net worth is going to fall, then you will hedge. And how much you hedge, that's your judgment, right? Okay, so this is the scheme of the project which we had planned out. Sorry, I never got to Khushbu's question. Yes, what is your question? Yeah, what is your question?
Go back to the calc.
To the calc, okay. Okay, so here. Yeah.
So, for hedging position P&L, you have taken the formula as
Formula is the same.
No, you have done 60.2 minus 50, right?
Yeah.
So
No. I have done, in this case, I've done it as 12 minus 13.
That's
No, don't need for you to write, because this is in your spreadsheet. You can just, yeah, 12 minus 13. What is, one minute.
Closing is exit minus entry price, right?
Yeah, so in 1 minute, it may be a little confusing because we have written the exit price first. Maybe that's why it's confusing.
We are short at 60.2.
Yeah,
So
that's the entry price. Yes, because you are, see, 1 minute, let's be clear, the formula doesn't change. The formula is already in your notes, you can look it up, go and look it up, but try to understand conceptually what we have done, as Tarun correctly pointed out, okay, where I was making the mistake. And the formula is always the same, it's a standard formula.
Still not clear that we are going short at 60.2.
1 minute, let's rewrite the formula. 1 minute, let's rewrite the formula for all position P&L, or P&L basically, okay? P&L is equal to position times, I can't even see where the star is, okay, position times, what should it be here, exit price. Actually I have to put, we are rewriting this, but let's do that. The font is big enough, Puneet? Okay, is this clear? Same general formula, it does not change for longs and shorts. That makes it easier to remember. That's what we should always try to do when we try to study. That's why when we study markets, we don't study just one markets and stock markets like most MBA programs cover. We cover all markets, because the framework of all markets, the general market framework like base asset, terms asset. Huh? What happened? Huh? What happened? Okay, guys, 1 second. Let's understand, just go and see what the problem is. Okay, guys. So let's understand this clearly. 1 minute. Please focus on what is being discussed. Manotra, don't look at your phone. Phone is here, okay. Don't look down. SG1, close the door. Okay, guys, let's make sure we are all clear about the formula, okay?
Yes, sir.
Let's make sure everybody is clear about the formula, because many of you have made mistakes even in the last exam. Formula is very simple. Logically, you can just remember it. It's always position size times exit price minus entry price. And the only tweak we have is, logically, when you are going short, you write the position with a minus sign, which is totally logical. When you're short positions, you write the position with a minus sign, okay, and nothing else changes, right? So if you put this is the only formula that we have applied in both the cases, okay. This is all there in your previous course notes as well. We had a long discussion on various types of calculations. So this is basically the only maths you need in finance. You don't need very hi-fi maths, but you should be comfortable using algebra because you can solve a lot of these recurring decision problems. You can just program it into your spreadsheet and makes your life much easier, and also prevents mistakes. If you're calculating everything all the time, you can make mistakes. So if you have it programmed, then you're not likely to make mistakes. Okay. All right. So is everyone clear about the formula? We'll explain it to her when she comes back. Okay. So that's all we have here. So we have this logic. I think anybody else is where's this calc? Okay, right? So we have applied the same formula. We just copied the formula from one cell to the other. So in both cases, all you have is the hedge position shows a profit, but the underlying position shows an equivalent loss. So your net movement in total P&L is 0 from the point when the price was here, from the point when the price was at 60.20, whatever the valuation was on the underlying position, right? That valuation is effectively maintained because all the loss in value in the underlying position from here to here, okay, is completely compensated by the offsetting profit in the hedge position. Is everyone clear? That's why we say that you have essentially locked in the valuation for the underlying position at this price. The scheme is clear, Aurora? What is your Microsoft, whatever game you are playing, what does it say? Does it show a profit or a loss? Okay. Put your phone down and focus on what is being discussed. Okay. All right. So, is this point clear to everyone? That when you go and hedge something successfully, whether it's successful or unsuccessful. Now we look at the unsuccessful part. Okay, we looked at the successful scenario. Your hedging was successful, so your view was absolutely correct. The market did collapse, so the underlying position lost value, but the hedge position made up offsetting amounts. So there is no net movement in the underlying position. Now let's look at let's look at the unsuccessful scenario. Okay, quiet here. What is happening here? No talking. Please make sure you focus on what's going on. Now, let's look at the unsuccessful scenario. Same setting. We starting point is the same. 60-20 we have. Now once again I have to cut marks for Gulati and Garotra. Now we have to move you somewhere here. Why don't you just sleep? Don't wake up. If you're waking up, it's like Kumkaran, you're waking up and making trouble.
He took my phone and she was asking me to get it back.
Oh.
Why will I get minus marks for that?
Oh.
Because you're talking.
Sir, I was saying a no to her. Sir, why will I get negative marks for that?
You were talking.
Because you're talking. No, but why did you wake up and start talking? No, you sleep. Okay. What happened? The phone has gone back to her.
No, sir, it's not with me.
Now I'll just have to confiscate all the phones at the beginning of the class. Okay, right. 1 minute. What were we discussing? No. We were discussing 1 minute. Alright, okay, 1 minute. Be quiet. I don't want to see any talking here. Okay, be quiet. So now let's consider the unsuccessful scenario. Okay. So the unsuccessful scenario is you still go short. You have a bearish view on the market, right? You go short the entire 25k. You hedge the entire 25k of inventory. Okay, so you sell 25 contracts at 60.20. Now the next moment the price goes to $70. Alright. So what happens is the next moment the price goes to $70. Now what has happened here? When the price, so now what do we change? Entry price does not change, right? The exit price changes. The exit price becomes $70, right? So we should actually make this equal to this so we don't have to write it twice. And the entry price is also equal to this. We are calculating the same. When you're writing it in your spreadsheet, you can write it this way, alright? So you can actually, but the hedge position will not always be equal to minus opposite of the underlying position because you may be doing partial hedging. You may not hedge the entire 25k based on your view, right? So we can't equate these two with a negative sign, right? So now what is happening when it's $70? What is happening to the hedge position? The hedge position is losing money because you're short at a lower price and the revaluation is happening at a higher price. So you went short, chart wise if you look at it, you went short here, okay, and then the market moved here, so obviously you're losing money, right? So the hedge position is losing money, right? But what is happening to the underlying position? What is happening to the underlying position? It's making money.
Yes, sir.
Because the underlying position is long. So the underlying position, the last revaluation of the underlying position was at 60.20, and the next revaluation goes to $70. Yeah, is this clear? Okay. So then in that case, the underlying position continues to make money, right? What happened? You want to go? What happened? You're not feeling well.
Sitting with me, she has some doubts. So
No, if you have doubts, you ask me.
No, sir, but then students laugh on others because we ask questions.
No, you don't worry about students.
No, sir, I will ask questions.
No, you ask questions. I have always encouraged people to ask questions. Okay, so you ask questions to me, don't ask questions to Tarun or anybody, okay? So nobody should be harassing people because of asking questions, okay? So people have a right to ask questions. So everybody should be asking questions. Whoever has any doubt should ask questions. Because when we see in the exams, we see many people are not able to answer things properly. Many people, their concepts are not clear, okay? But at least she's asking questions.
yes, sir.
But other people are not. Parul also asks questions. Many other people. Chuk also. Chuk after getting his job now, Chuk is relaxed. So he's no longer asking questions. So, but before that he was asking questions. So people. Saloni also asked a lot of questions. Okay. So people who ask questions. Garvit also asks questions actually in between when he's actually in the class. So asking questions is always to be encouraged. So nobody should be trying to harass people for asking questions. Okay. So let's make that very clear. Okay. All right. Now, what were we discussing? So can we now let's go back to your question here. Now let's explain once again. The formula that we hear, so make sure you understand that the formula that we are using, this is already there in your previous notes, but we have written it again. Is the font big enough?
Yes, sir.
So the formula is always the same. We don't change the formula for long positions or short positions. All we do is that when we are looking at a short position P&L calculation, we write the position with a negative sign, which is logical, right? That's all we are doing. So it's the same formula that is being applied in both cases, right? Exit price, position into exit price minus entry price. Same formula, okay? This is already in your notes and it's also in your previous notes. Okay, so now you can see this. Right now you see this here, that so we are actually considering a different point of view now. See if you can if this makes sense. So let's be clear, the P&L formula in both the cases is the same. It's an identical formula. We have just written the exit price first and the entry price later. Maybe it would have been more intuitive to write the entry price first and the exit price later. So the formula is that same formula we have taken and we have written it here in the two P&L cells. Same formula, no change. Okay, so the underlying position remains long. Now we are considering a different situation where your view doesn't work out, but we're trying to illustrate the principle that your price is still locked in. Okay, the price is still locked in at the price at which you hedge. The net realization for your inventory, okay, net price realization for the inventory that you're hedging is locked in at the hedge entry price, at the hedge position entry price. That's what we are showing. The hedge position entry price in both the cases is, the two cases are where your view works out to be correct, and the second case we are discussing is where your view works out to be incorrect. Your view turns out to be incorrect. In both the cases, the entry price on the hedge position is at the price at which you hedge, right? So we are saying that your net price realization for the whatever item on the balance sheet that you're hedging, right? It's not always an asset or anything, it might be a liability, but the net price realization or the net price valuation, net valuation for that particular item on the balance sheet is locked in at the price at which you enter the hedge position. This is the principle that we are illustrating, okay? So maybe we can write this down as a principle, if it's not, in case it's not already in your notes. This is the principle that we are discussing, that net realization, okay, or value realization net for asset liability position value realization for asset liability position is locked in at hedge position entry price. This is clear. This of course is only true provided 100% of the amount is hedged, because of the way I've written the first part of the sentence. Provided 100% of underlying position is hedged. Yes, is this point clear to everyone? Is this clear why I've written it this way? Yes. That essentially the point we are trying to illustrate, maybe the wording can be made a little more elegant, can be made a little bit more elegant, but what we are trying to show you is that the net value realization, because we can't always write the net price realization because that would refer to inventory items, but sometimes you have liability items also that you're hedging. So we are talking about the valuation of the liability items. Okay, so the net value realization or the price realization for the asset liability position that is being hedged, right, is locked in at the hedge position entry price, provided you hedge 100% of the position, because of the way I've worded the first part of it. Okay, because I've not written like for the amount that is being hedged and all that. That's the only principle. This point is clear to everyone?
Yes, sir.
Okay, that's all we are trying to illustrate here. That now in this case we are talking about a situation where you go short and your view turns out to be wrong. You go short because you have a very bearish view on the market, but in fact what happens is after you go short 25 contracts here, the market shoots up, right? The market shoots up to $70, right, after going short at 60.20. So in this case the calculation that we do to figure out what happened to our total to our hedge position P&L and underlying position P&L, the calculation that we do is here, right? We look at, we already have as the same because we are hedging 100% of the position for this example, right? So the entry price remains the same, 60.2. The exit price now is $70 because the period 2 price is $70. So we are considering the impact on the P&L between period 1 and period 2. Okay, so the period 2 price is taken as the entry price, the last price is taken as the exit price, and the entry price is the first period 1 price. Okay, is everyone following the scheme? Yes? Right. So in this case what happens, you see that the hedge position loses money because obviously you went short over here, and after going short the market shoots up, so you're losing money per unit, and you've got 25 contracts, so you're losing 25,000 into this amount of movement, and that loss is equal to this. So the hedge position is now showing a $250,000 approximately loss. Yes, this is clear. Now what is happening to because your total P&L is actually hedge position P&L plus underlying position P&L, right? As you see in your scheme of reporting, right? The total P&L is actually this plus this. These two put together is your total P&L. That's what you're really concerned with. Okay, so in this case when you see what is happening to the underlying position P&L, the entry price for the underlying position P&L has to be the last price at which it was revalued, which is the period 1 price, which is 60.2, and the exit price will be the same period 2 price. So you see here, because the underlying position is long, when the price moves from 60.2 to $70, there is a profit on the underlying position. Is everyone clear? There is a profit on the underlying position, because if you're long, you can just look at the chart here and see it. If you're long and the price moves up from here to here, you're making more money. Yes. So what is happening here is that the underlying position is making money, but the hedge position is losing money, and the amounts are offsetting. Okay, this first plus 245k minus 245k. Yes, so they're offsetting. So what is happening? So then if we ask this question, what is the change in my total P&L from this point number 1, period 1, where 60.2 was the price and I decided to hedge my entire inventory? From that point onwards, what is the incremental change in my total P&L? No change. Change is 0, because whatever was gained on the hedge on the underlying position was completely lost, offsetting loss on the hedge position. So this once again shows you that once you hedge a certain amount, okay, and if you're taking a simple example, you're taking a static hedging program, once you hedge a certain amount, you have effectively locked in the valuation of the underlying position at that hedge position entry price. Is Is this clear? This is the only thing that we are illustrating here in this, when using this language. This is not the one. Okay, so the language may not be very elegant, okay, because I'm just writing it now as we discuss it, but this is what this means. Point is clear? Okay, so you understand the scheme of the project, that this is how the project is going to work. You cannot touch the underlying positions because they are affected by how the business is operated. So your goal is to make sure that you monitor the market if the net worth is likely to go down because of any adverse revaluations on the underlying positions, whether assets or liabilities. Okay, you have to project that. Okay, you project that based on your view, and if you feel that this is going to happen and this is going to have a negative impact on the net worth, then you will enter the appropriate hedge positions. And what amount you enter, that's based on the strength of your view, etc., and whatever plan you have. So and you do that, and then hopefully you're right and you're able to therefore lock in. So imagine that essentially the goal of a hedge program is right now, say crude oil prices are rising, if these guys take a view that the market is bullish, okay, and this is going to break through 62.5, eventually head over to $100, okay, so then what will they do? Yes, if the underlying position is long and the hedging team has a view that the crude oil price is bullish, the outlook is bullish, and prices are going to go up, okay, shoot up to $100 eventually, then what should they do on the hedging, as far as the hedging is concerned? Yes? Nothing, right? So they should do nothing, because you basically don't project any adverse movement in net worth. You actually see the net worth going up. So it's clear. Yes. So eventually, if you imagine that if the whole point of hedging is that you follow the market, if you feel the market has reached the top, let's say at 72.50, you feel that okay, this $100 view is not likely to be correct, okay, it won't go above 72.50, and the market has already reached this level. At that price, you lock in. So that means what you have done is you have locked in this realization for the inventory at 72.50. At that time, you go short on the hedge position, and even if you are not correct, you are still able to lock in. The effect is always the same, that you are able to lock in the price for the valuation level for the asset or liability item on the balance sheet at the price at which you enter the hedge position. Is this clear? The principle is clear to everyone? Yes. Okay. So the goal of good hedging is to wait until you get an appropriate price, okay, and then only enter the hedge position. Obviously, it's all based on your view being right or wrong. Okay. Right. Let's see if we have something else here. What is the next point I was going to discuss? Okay, now this is a very important point. I want to quickly discuss it. We have a little bit of time. Very important point. Why, when I asked you that, of course, again, don't understand this mechanically. This is also written in your notes. Everything is written in your notes. This is part of your project brief, actually. So let me make this big enough here, and let's go to the end. Right, end. Right, the golden rule of hedging. We are going to discuss the golden rule of hedging. Okay, again, first I'll just explain the concept briefly to you, and then we'll do some calculations based on what we did earlier. But the golden rule essentially is that one of the reasons you don't increase, like if you remember when we were discussing this question earlier, a lot of people said that if your underlying position in this KRF market is long, and your view on the KRF market is that it's very bullish, it's likely to go up, and then I asked them, what will you do on the hedge as far as the hedging is concerned? A lot of people said we will buy, right? The reason you don't do that, one of the reasons you don't do that, of course, because we've given you this logic that you are really concerned with what is likely to happen to the net worth. If the net worth is likely to improve, if you don't do anything, then you don't do anything, right? So, because by doing something, you would have locked in this price, and the net worth will actually be prevented from improving. If you did something, and if your view is correct and it actually goes up to $72, you would have forfeited all those profits which you could have made on the underlying position. Okay, you would have locked in the underlying position valuation at this 60-20. The reason you don't do it. So here basically this leads us to the formulation of the golden rule of hedging. Now it sounds a little complicated, but you'll understand that your net of initial underlying position adjusted by hedge account position, which means hedge position plus minus Underlying position plus minus. Okay, this is all part of your notes. What I've done is I've taken your project brief and I've pasted it onto the end of your technical note on risk management, so that I don't have to open an extra document while discussing in class. But your project brief is also there as a separate document. Okay, but this is only for my convenience, so I've just pasted the project brief. So this is part of your constraint in the project brief. So you have to make sure that at all points of time your total positions does not exceed, okay, the initial amount of the underlying position and does not fall below 0. Okay, so what is the rule we are saying? That the net of the two positions, the sum of the two positions, hedge position and underlying position, cannot ever go outside the bound of 0 and initial amount of underlying position. Which means, let's take it with the example of the crude oil, which we are discussing, to keep it simple. Okay, so your starting position is, underlying position is 25k. All right, so that's why we said, so in this case what this means is, okay, initial amount means at each period. So later on, if the hedge sales team updates you that we have sold 15,000 barrels to Japan, then the new position is 10k. Then we'll be working as 10k. This 25k, whatever we are discussing in this part, that will become 10k. Whatever is the initial for that particular period. Every time you change any of these position, if you update the position size based on the input from the sales team or the treasury, which takes a new loan or something, every time you change that, we take it as a new period. Okay, effectively for this principle, right? The initial period of the initial part. So understand this initially for that. So if you're 25,000, this means that your total position, hedge position plus underlying position, cannot go outside the range of 0 to 25k. Okay, this is what the golden rule of hedging. You can go and think about it later, but it's very simple. Actually, it sounds much more complicated than it is. Okay, it sounds much more complicated because it has to be written in a very mathematically precise way, so that it is an objective rule which a computer will also understand. It has to be written like that. So when you write it like that, initially it seems very complicated, but this is all that it means is, in this case, because remember, you're hedging. Your goal is to reduce risk. If your goal is to reduce risk, okay, so if you are bearish, you can't sell. If you are very bearish, you can't sell like 50 contracts, because your underlying position is only 25 contracts. If you sold 50 contracts, then you are increasing your risk once again, right? So therefore you can't do that, because the goal of hedging is always to reduce risk and to bring certainty to cash flows. Remember that philosophy of risk, because many professionals also don't understand. Many treasuries go bust. Many companies go bust because they have all these kinds of disasters. Okay, very well-known big publicly listed companies, they don't follow these simple rules. So the goal of hedging, you have to always remember, is to bring certainty to cash flows. Okay, so therefore to bring certainty to cash flow and to reduce risk. So that's why your total position has to remain between 25k was your starting point. Yes. At any point of time, your total position, when we took a total of hedge position plus underlying position, can't go outside the range of 0 to plus 25k. Yes. If you're very bearish, you don't sell 50k, 60, you don't sell 60 contracts, 90 contracts. You only sell a maximum of 25 contracts. And if you're very bullish, you don't buy anything, because your underlying position is already long. If you buy, then your total position, if you buy, say if you're 25 contracts long, underlying position, and you buy 10 contracts, wow, I'm very bullish, let's buy. Then you've gone to 35 and you've violated the golden rule of hedging. Are you following?
Yes, sir.
Okay. So therefore, please make sure that this you understand this concept. Okay, we'll just briefly touch on it in the next class. Okay, but the point is, make sure you understand this principle, very important principle. Okay, instead of folding up, we still have 1 more minute. Please make sure you understand this. This is an important constraint. This also has to be adhered to. Okay, when you're running your project. So I will have to take all your PDFs, because I have to make sure that randomly doing audits and making sure that any point of time your total position did not, because I know the underlying positions and hedge positions will differ for each team. So I will do random checks to ensure that no team has violated this rule.
Will be given underlying position.
Underlying position is given to you. Everybody starts with the same underlying position, but your hedge position may not be the same as Arora's hedge position. No, at any point of time. So if he's on a different team, he'll have a different view. Right? So is this clear to everyone?
Yes, sir.
Golden rule of hedging. Why do we have this rule? Because you cannot increase risk through a hedging program, which many companies actually have done. These are all just risk management disasters. JP Morgan lost more than $6 billion just a few years ago. Okay, so no, hedging cannot lead to the increase of total risk. That's why I've defined the hedgers as reduction of total risk. First transaction in financial markets will always reduce the total risk, because once again you see that. Can you see that rule? If you apply the golden rule of hedging, the first transaction has to always reduce risk. It cannot increase risk. If you do dynamic hedging, the second transaction can once again increase the risk, but the first transaction always has to reduce risk. Is this clear? Everyone has understood all these points? Okay, please write it in your WhatsApps.
But it will be replaced fully now in the coming
It will be. I don't know what the schedule. So your question is with regard to LIBOR. Why is LIBOR being discussed and not SOFR? Okay, because SOFR is still quite new. Okay, so if you look at the current set, if you take a snapshot of outstanding loans today, okay, the big chunk of outstanding loans is still in floating rate loans. It's still indexed to LIBOR, not SOFR. Okay, if you look, you have to look at the legacy. Okay, because the world has been operating against LIBOR since the mid 70s. Okay, so all these loans that have been built up, so it's still very LIBOR based. Okay, but so they've done two things. They have tried to tweak the fixing process so that there are no, we don't have a repeat of those cheating incidents. Okay, manipulation of the rate, and then they are also trying to set up SOFR, which is much more on an actuals basis. Okay, yeah. So but the transition to SOFR is far from complete. Okay, so therefore still you have to be aware of LIBOR, and all that will change. None of your risk management principles will change. All that will change is when you go to SOFR, you will have a new euro-dollar futures contract like this one. Now will be basic. This particular contract here, okay, will be based on, again, you'll have another contract against SOFR, but the principles of hedging and the thinking will not change in any way, because now you'll be taking views on SOFR and then deciding whether to hedge or not to hedge. Right now, later on, and now what you're doing is you're taking views on the cash market euro-dollar deposit, and this is also going to be the same kind of view. It's a view on a short-term interest rate, right? So therefore it will be the same. So that's why I gave you the idea of SOFR, okay, that there is something new called SOFR, and I'll try to put some links in for SOFR as well, where you can read. So you researched it on your own. Very good, very good. So I'll put in some links, okay, so you can study it. But you have to also be aware that the huge legacy of LIBOR for so many years, that cannot be undone overnight. No? You have to let these loans roll off, okay, and new loans you have to see. Even today you will see loans being given against LIBOR, because all the hedging, the transactions, the agreements, the ISDA confirmations, everything is against LIBOR. So they'll have to rewrite all that. Okay.
But why it has been changed to SOFR? I guess.
Why has it been changed?
Yes.
Yeah. So
because of financial crisis that happened.
No. Because I told you, no, they cheated on LIBOR.
Okay.
Remember how LIBOR used to be?
But it is because of financial crisis.
And don't read net. I'm telling you, don't read the net. Don't read all this weird sites. You read only the sites that I'm giving you, the books that I'm giving you. Don't read here and there on the net what Quora is saying and this and that. You will get all kinds of stupid ideas. These people don't know what they're talking. I already explained this to you in the class.
Even in Investopedia, some things are given like.
Don't read all that. I've told you. You read only the links that I'm giving you, and on the books that I'm giving you. Don't read outside that. Okay?
That's why
because you there are lots of people writing all kinds of stuff on the internet. They don't know what they're writing actually, right? So don't read all that stuff. But why did you even then it should have struck you that it's not matching with what I said. If you remember what I said in the class, that SOFR came into play. Why? Because these guys cheated on LIBOR. How was LIBOR being fixed? LIBOR was being fixed like you get a bunch of banks together, you call them up and ask them at what price are you going to be likely to borrow, okay? or at like what price are you likely to lend to other banks in the system, okay, and you will give a rate, 6%, he will give 6.2%, he will give 6.1%. Then they'll throw out the last two, widest two rates, okay, highest and lowest, and then they'll average the rest. And then they'll publish that at LIBOR. So now this is subject to, if I want to rig it, I will call all of these guys and say, okay, let's do a conspiracy. Let's show the rate as being much lower than it actually was, right? You may be actually able to borrow only at 7%, but he will show the rate at 6.2. He will show at 6.1. You will show at 5.9, because you're all colluding with each other. There's a conspiracy, okay, to rig the rate. And that gets published as a lower LIBOR rate. The reason this happened is because the LIBOR rates were affecting the commercial banks, and they were in trouble because of the financial crisis, because there was a credit crisis. So the statement is not wrong, but it's not sufficient. It's not sufficient. It actually, what happened is because they had funding problems. So they wanted to avoid people getting panicky about their funding rates. Because see, if I know that Tarun's company is borrowing at higher and higher rates, banks are charging his company higher rates, then I will also become careful. Why are banks charging him? That means his credit quality has gone down. That's why banks are charging him a higher rate. So that he doesn't want that information out in the market. So he wants to show that he's borrowing at lower rates. That's why they rigged it. Okay, so that's why this is always going to happen whenever you have a survey-based rate. SOFR is not a survey-based rate. It's an actual transaction-based rate. Okay, what rates that you actually borrowed at? So value weighted average. So if you borrowed 100 crores, he borrowed 50 crores, your rate will have double the weight. Okay, so it's a volume weighted average. So now you're going to a transaction based rate in SOFR to avoid these kinds of cheating incidents. Okay, so the statement is not incorrect, but it does not give you all the information. You don't get all the logic. But I mentioned this in the class because they cheated. That's why we moved to SOFR, right? But the transition is not complete. Yeah. Anything else? Okay. Yeah.
You were saying that golden rule, that position should not go lower than 0 and more than 25k.
Yeah.
So, sir, we don't do anything to position. So why this rule is with? Like, I don't see any logic for this rule, because we are actually not working upon the position size. We are just working upon the prices of the.
No, because see, you also have to understand that just like your total PNL is equal to hedge PNL plus underlying position PNL, right? So similarly, your total position at any point of time. Remember how I defined hedgers and speculators? That total risk. So first transaction reduces the total risk. What is that total risk referring to? Why didn't I just say risk? Because it's total risk, which is the sum of underlying position risk plus hedge position risk. Okay, and risk in this case is measured by the total size of the position. The bigger your position, the higher the risk.
So you are saying that if we are long on underlying, so we shouldn't go long on hedging also.
Yeah. So don't say long on, say long. Long underlying. Yeah.
We will not go long hedge also.
Yeah. So because if you're long on the underlying, that's why you have the golden rule, that the total position, which is hedge position plus underlying position, which is basically a proxy for your risk. The bigger your position, the more risk you have, because the market can go either way, right? So that's why you have to have this rule that you don't, because you as a hedger you can't increase your risk.
Yeah.
From the total amount.
If we like playing with this rule, then we'll be increasing our risk. It's
if you don't follow this rule.
Yeah.
If you don't follow this rule.
Because if we hedge for more than 25k, then also we are increasing our exposure. And if we if we do the same position as that we are in underlying, so then also we are playing with our risk.
The second part of the statement did not.
Like if we are long in underlying.
Don't say long in underlying. Long underlying.
Long underlying, we shouldn't go long hedge.
Yeah, but if you're running a dynamic hedging program, you can go back from 25. If you've gone from 20, the first transaction has to reduce the total risk.
Yeah.
Okay.
No,
but
I'm saying
you can't go above.
At no moment we'll go above the.
Yeah. So your total, you always have to keep your eyes on the total position.
Yeah.
When you start, the hedge position is 0. At the start, the hedge position is 0. So you only have the underlying position. So if you do any hedge transaction, the first transaction, that's why I've defined it in that way, that your first transaction must reduce your total risk. Total risk is hedge position plus underlying position. So the first transaction, why? And that's again because of the operation of the golden rule of hedging. that you cannot increase if you're bullish on the underlying position KRF market, okay, then you cannot go long immediately. The first transaction must always reduce your total risk, so you can only come down. And if you go if you are long 25k long,
don't do anything.
yeah, if you are long 25k and you sell 45k, that's also not allowed, because then your first transaction is increasing your total risk, because you're going net short 20k. That's also not allowed, because the goal of hedging is, the philosophical aegis of hedging is that you must be reducing risk and bringing certainty to cash flows. Okay, this principle has to be also understood, the philosophical approach to hedging.
It's based on that.
Yeah, that's what drives all this. Huh? So that, and many people, the funny thing is that many people don't understand it. People, professionals working in publicly traded
Then we
companies.
shouldn't say it hedging.
No. Yeah. In that sense, what we say is that you have violated the rules of hedging.
Then it's not hedging. No?
Yeah, that's what I'm saying.
Taking a view on market.
But in fact, it happens with hedging teams in the real world. They don't follow the discipline. It's a compliance problem. It's a compliance failure. But it happens. I mean, whenever you have human beings, you'll have compliance failures.
But I have seen 2-3 companies auditor report. I didn't saw any of this.
But auditors may not even have understood all this. Auditors may not understand all this. They may not be looking out for all this. JP Morgan lost more than $6 billion just few years ago. I think they were running a hedging program, and they morphed into a speculating program.
Okay.
But a bank like JP Morgan lost $6 billion in the chief investment. You can look up the scandal. There's actually a Harvard case on this. It's called the London Whale story. Okay, they were trading credit derivatives, and they got confused basically. They started out with the idea of hedging, and then it morphed into, it's very natural with human beings, it's very natural. That's why you need all these frameworks. That's why you need all these ideas and rules to make you stay focused.
Obviously, we don't focus on increasing our NAV, but we are focusing on not decreasing our NAV. That's the purpose of this.
So you do focus in a way that if you feel that the net worth is going to go up based on market movements, in that case you don't do anything.
Natural.
You don't do anything, so you're still focused on it. Yeah. So it's not really that you can't say that you don't focus, but your action is different.
Yeah.
Your action is
We are
different.
not doing anything for that.
And why is the action different? Once again, golden rule of hedging. That again crystallizes and forces you to understand the concept of hedging being a risk reduction approach. Yeah? Clear? Okay, so all this is being recorded, so that's good, so that people can listen to it later. Right. Yes, you have a technical question? Okay, so then we'll